Over the last 25 years, we showed a chart going back to 2000 where Bloomberg Commodity Index and the gold were measured against each other. And gold is now back at its all-time highs of the last 25 years. There was a period there when gold had doubled in price between its 2015 low and the mid-2020, summer of 2020 high. Went from 1,050 to 2,070, almost doubled. During that same time, Bloomberg Commodity Index was still going down. Commodities were not following gold. And then when gold paused for a couple of years there, it frustrated everyone, went into a range that was at max 20% wide, but most of it was about 15% wide. Bloomberg exploded. So the Bloomberg versus gold spread collapsed versus gold. So gold underperformed during that period from about 2022 to early 2024. Now has exploded back up again, back to its all-time highs, gold versus commodities. But it's our technical assessment and fundamental assessment that the commodity complex will be a place that exiting money from the stock market will be going. And I don't mean going into corn futures and oil futures, but into stocks related to those commodity markets, like oil-related stocks, base metal-related stocks, agricultural-related stocks like fertilizer and so forth. There will be a place to go. So if you're looking for an alternative place within the stock market, I would be looking at commodity-related sectors, and particularly, I think, ag sectors, agricultural-related, would be a best place. Then there's the issue of the gold miners, the dogs, gold and silver miners. And it traces back to 1986, that index. So it's also not an ETF. It's not traded as such, like GDX is. But if you measure that index from its bare low in 2015, coincident with when gold made its low, it's gone up like 120% at current price levels. It's actually, since the S&P, it beats the S&P, but nobody notices this marginally. But it beats the S&P over the same span of time. And yet it's hard to believe that, but you can actually measure it. But when you look at the long-term charts of the gold mining sector, the price charts, but especially when you look at its valuation versus gold, the miners, how cheap are they versus an ounce of gold? Or how expensive are they? Right now they're on the floor, okay? And they've been there since 2015. Not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be, especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. They're not going to go out and buy gold, silver futures and use leverage. And they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector and it's so undervalued, not only in relation to gold, but in relation to the S&P. It won't take much money flow, the blood flowing out of the stock market into some other category to boost the gold miners off the page because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, and they don't. Sometimes they actually lead. People overlook that. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet, is in gold and silver miners in 2025, because they're monetary, they're money. But even raw commodities like copper, let's say an industrial metal, looks poised to go up while the stock market goes down.
Over the last 25 years, we've seen dramatic shifts in financial markets, particularly in the relationship between gold and commodities. If we go back to the year 2000 and measure the Bloomberg Commodity Index against gold, we see a revealing trend. Gold has now returned to its all-time highs in this 25-year period. There was an especially notable moment when gold doubled in price between its 2015 low and mid-2020 during the summer highs. It went from around $1,050 per ounce to approximately $2,070. Yet during that same time, the Bloomberg Commodity Index was still declining, showing that commodities were not necessarily tracking gold's performance. However, once gold entered a frustrating consolidation period for nearly 2 years, commodities finally exploded, causing the spread between commodities and gold to collapse. Now, in early 2024, gold has once again surged back to its historical peak against the commodity index. Based on both technical and fundamental assessments, it is highly likely that we will see a shift where capital exiting the stock market finds its way into commodity-related investments. But let's be clear, this does not mean a mass movement into futures contracts for corn, crude oil, or metals like copper. Instead, it points to a shift in focus toward commodity-related stocks, companies dealing in oil production, base metals, and agriculture-related businesses such as fertilizer producers. These sectors are poised to benefit from a rotation in capital as investors look for alternative investment opportunities amidst market uncertainty. The gold mining sector, which has often been overlooked and dismissed as an underperformer, is another area of significant interest. If we track the sector's performance from its 2015 bear market low, a period that coincided with gold's bottom, it has actually risen about 120% as of today's price levels. Surprisingly, this is a slight outperformance of the S&P 500 over the same period, but few investors have noticed. This discrepancy is largely due to the perception that gold miners have been dogs in the investment landscape, meaning they have been ignored and dismissed. However, the reality is that since 2015, miners have held their ground and have actually gained in value alongside gold. One of the most revealing metrics is the valuation of gold mining stocks relative to gold itself. Right now, mining stocks are trading at historically low valuations when measured against gold prices. This means that miners are still drastically undervalued compared to the price of physical gold, making them an attractive opportunity for investors looking for leveraged exposure to the metal's bull market. Historically, when capital begins shifting away from general equities and into alternative investments, mining stocks tend to be one of the first beneficiaries. In 2025, when we inevitably see a broad rotation of capital out of the stock market, gold and silver miners will likely emerge as a key destination for investors seeking safety. Many investors who want exposure to gold but are not accustomed to trading bullion or futures will likely turn to mining stocks. Since the mining sector is a relatively small corner of the market, it won't take a significant amount of capital inflows to generate outsized returns. If we take historical market trends as our guide, we can expect that mining stocks will eventually transition from being overlooked to becoming a leadership sector, with investors rushing in once their true value is recognized. Beyond gold and silver miners, we should also consider the broader commodity market, particularly industrial metals like copper. Industrial metals have a strong chance of rising while the general stock market declines. If we look back at the late 1970s, a period of economic stagnation and inflation, often referred to as stagflation, commodities surged despite a weak overall economy. Between 1977 and 1980, commodities led by gold experienced dramatic gains while equities struggled. During that same period, the stock market endured prolonged stagnation, yet commodities exploded in price as capital rotated into real assets. Many investors forget that these historical patterns exist because they are overly focused on short-term events. While it's true that gold has occasionally suffered brief pullbacks in conjunction with stock market corrections, such as during the 1987 market crash or the 2008 financial crisis, these moments have typically been temporary. The more important trend to focus on is that gold has historically performed well during extended periods of stock market weakness. Looking ahead to 2025, the fundamental and technical signals strongly suggest that we are on the verge of another major shift in financial markets. The key takeaway here is that the capital that once flowed effortlessly into growth stocks and speculative assets will likely begin seeking refuge in commodities, gold, and related investments.
If you go back and look at the late 70s, we had stagflation. Economists couldn't figure it out. How can you have inflation and yet collapsing, a wasteland in the stock market for a decade almost? And yet commodities exploded all during that time, the 77, 78, 79, and 1980. They went up with gold, not as much, but they went up strongly. And yet we're in a global recession. So the examples that people remember and are burned in their memories are very isolated instances where gold temporarily had a bad month along with the stock market. I caught the crash in 87. I didn't catch it in a big way. I caught it in a small way, but I did it with puts. So I got my customers in it as well. I was a futures broker. And I learned a lesson. But during that collapse, and gold wasn't even in a dynamic market at that time. It wasn't, you wouldn't define it as a super strong bull market. But the stock market collapsed, gold went up 10% that week. Same week that stocks went down 30-something% and went up 10, okay? So, but you go back to that 2008, 7-8 bear market. In October of 2008, there was a crash type event in the stock market, but it was a full year off its high. It had already been in a bear trend since September, October of 2007. So in October of 2008, way off the price high. And gold at that point had been rising sharply in that period of time, but suddenly in August, September, and especially October, gold had a relapse. It needed to have a correction. It was technically ripe to have one, but it lasted basically 1 month where it was doing the same thing as the stock market. And then the stock market continued down until March of 2009. Gold was back at its highs by then. People ignore that. So yes, there was a 1 month phenomenon. Also, COVID event was another time, but they're isolated events and they're not part of major trends. They're hiccups. And yet people seem to have that only in their mind, not the major trends. And if you go back and look 2000 to 2002, major bear market, dot-com collapse, gold was up all during those years, okay? And from 2000 to 2011, gold had a massive up move had an interruption in October 2008. But during that same period of time, the stock market was not performing well. It was in a lateral position since its 2000 high. In fact, after the 2000 peak, it took the S&P 13 years to finally go up and exceed it and move on up. It was until 2013. For the NASDAQ 100, after it peaked in the year 2000, it collapsed, and it was 16 years before it could ever get back to the price high that it had seen in 2000. So if you factor in, if you didn't get out in 2000, and by the way, MSA put out a major sell signal in January. Yeah, it took it about a year to collapse, but it finally did. But it took it 16 years. Imagine not having gotten out and not gotten long gold during that time. Gold was very cheap then, year 2000. It went up through 2011. It took you 16 years to nominally get back to the price high you saw in 2000. I say nominal because the degradation of money over that 15 years, the real buying power, collapsed big. Because, the money supply almost doubles every decade. So you've got to keep that in context. A lot of people are too focused on one minor event here and one there. They isolate, and they don't see the real context.
As we move into 2025, the cracks in the Western financial system are becoming impossible to ignore. The debt mountains that have accumulated over decades are now standing at a point where collapse is not just possible, but highly probable. Governments, particularly in the West, have consistently chosen the path of monetary debasement rather than responsible fiscal policy, and the result is an unstoppable force of inflation, stagnation, and declining confidence in fiat currencies. Meanwhile, on the other side of the world, BRICS nations and other emerging economies are preparing for a future that no longer relies on the US dollar as the primary global reserve asset. The accumulation of gold by central banks, particularly those in China, Russia, and the Middle East, indicates a clear strategy, one where gold once again plays a central role in global trade and finance. If we examine the debt dynamics of the United States, the situation is even more alarming. The U.S. national debt has now exceeded $36 trillion, with annual deficits consistently running into the trillions. Just the interest payments on this debt have reached unsustainable levels, surpassing $1 trillion per year. This is the kind of scenario that history teaches us leads to a currency crisis. Investors who have faith in the longevity of the US dollar and US treasuries are making a fundamental miscalculation, similar to those made by investors in past empires that ultimately crumbled under the weight of their own financial excesses. In the 1970s, we witnessed a similar period of monetary stress. The US had severed its gold backing in 1971, thanks to Nixon's abandonment of the gold standard. Almost immediately, inflation spiraled out of control, leading to gold skyrocketing from $35 per ounce to over $800 by 1980. Fast forward to today, and we see the same elements at play: persistent inflation, geopolitical instability, declining faith in the monetary system, and an accelerating trend of de-dollarization. Unlike the 1970s, however, the US no longer has the same economic dominance or manufacturing base to fall back on. This makes the situation today even more precarious, as the only way out for policymakers will be either extreme monetary debasement or a restructuring of the financial system that involves reintroducing gold as a core asset. We must remember that gold is not just another commodity, it is money, the oldest and most reliable form of money in human history. When confidence in fiat collapses, gold is where wealth seeks refuge. Today, central banks are the largest net buyers of gold, accumulating record amounts for nearly 15 consecutive years. The most aggressive buyers? China, Russia, Turkey, and other nations that have a vested interest in reducing their reliance on the US dollar. This is no coincidence. They understand what is coming. The key question investors should be asking themselves is, why are central banks buying gold at an unprecedented rate? The answer is simple. They know the end of the fiat experiment is near. China has quadrupled its gold reserves since 2008. Russia has increased its holdings dramatically. Even India, despite its historical efforts to curb gold imports, has started accumulating more aggressively. Meanwhile, the average Western investor remains oblivious, trapped in the illusion that central banks have everything under control. Silver, often referred to as gold's more volatile sibling, is an asset class that is widely misunderstood. The gold-to-silver ratio currently stands at an abnormally high level of around 85-1, meaning that it takes 85 ounces of silver to buy 1 ounce of gold. Historically, this ratio has been much lower, often around 16-1, when silver was still widely recognized as a monetary metal. The current disparity suggests that silver is grossly undervalued and could see exponential gains when the financial reset occurs. Silver is unique in that it is both a monetary asset and an industrial metal. Its role in the global economy is expanding due to its use in solar panels, electric vehicles, 5G technology, and medical applications. Demand for silver in industrial applications is surging, yet supply remains constrained due to falling mine output. Given this, it is not difficult to envision a scenario where silver outperforms gold in percentage terms during the next monetary reset. BRICS nations, Brazil, Russia, India, China, and South Africa, have already signaled their intent to move away from dollar dependency. In 2025, the BRICS bloc is expected to further develop a gold-backed settlement system that allows member nations to trade without relying on the US dollar. This would be a significant blow to US economic dominance and further diminish the demand for US treasuries. Saudi Arabia's increasing ties with BRICS should be particularly concerning for Western policymakers. The petrodollar system, established in the 1970s, has been one of the key pillars supporting US dollar dominance. If Saudi Arabia and other OPEC nations start accepting gold, yuan, or other alternative currencies for oil, the dollar's role in global trade will decline rapidly. Once the dollar loses its status as the sole global reserve currency, hyperinflation in the US becomes a real possibility. One of the greatest ironies of the modern financial system is that while central banks are accumulating gold at record levels, the average Western investor remains largely disinterested or unaware. This is due in large part to decades of financial repression, a system where policymakers deliberately suppress gold ownership through derivative markets, central bank interventions, and misleading economic narratives. Consider this. If gold is such an outdated, barbarous relic, why do the most powerful financial institutions in the world continue to hold it? The Bank for International Settlements, BIS, recently reclassified gold as a Tier 1 asset, meaning it is now considered as safe as US Treasuries for banking reserves. If gold was irrelevant, why would the BIS, the central bank of central banks, make such a move? Historically, gold bull markets unfold in 3 phases. Smart money accumulation. This is where central banks and deep-pocketed investors quietly acquire gold while the public remains indifferent. Institutional participation. This is where hedge funds, pension funds, and mainstream investors start to take notice and move into the market. Mass public mania. This is the final phase, where the general public panics and rushes into gold at exorbitantly high prices. Right now, we are somewhere between Phase 1 and Phase 2. Once we enter Phase 3, the opportunity to buy gold at reasonable prices will be gone. Gold at $2,700 per ounce today may seem expensive, but if history is any guide, it could be $5,000, $10,000, or even $20,000 per ounce before this crisis is over. The year 2025 will be a turning point for the global financial system. The dollar is in decline, debt levels are unsustainable, and gold and silver are re-emerging as monetary anchors. While Western investors remain complacent, central banks, BRICS nations, and institutional players are positioning for the inevitable reset. For those who understand the cyclical nature of monetary history, the strategy is clear. Own physical gold and silver, avoid excessive exposure to paper assets, and prepare for the most significant financial transformation of our lifetime. The time for speculation is over. The time for preparation is now. As the legendary investor Jim Sinclair once said, gold is the final refuge against universal currency debasement. When all else fails, gold will be the only asset left standing. Are you ready?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.